Good definitive leadership answer. All right, so I think all or most of you have been here for the last few days, so we'll give you a hall pass on introductions, and we'll just dive right in. But just for context, today is your math and numbers day. So we'll be talking about capital strategy, finance strategy. This is not done. There we go.
No?
Yeah.
Great.
So we'll be talking about finance strategies, and with this segment, this is a fairly quick segment, but we'll just talk about how we think about tranching and how we think about TRA and CHE, where we are breaking raises up into smaller bites for investors to mitigate risk and for entrepreneurs to mitigate dilution. And those two things go hand in hand. And so we'll talk about risk and dilution as we go through this process. So goals for this is looking at the entire capital intensivity of any particular company and how much money it will take. We'll also look at the timing. And then, as usual, we will tie all of that back into the exit strategy to make sure it all works together holistically across the entire financial package. So you already have the pro forma work we did yesterday and the exit strategy canvas work we did on Monday. So these two segments will follow on those and build on what we have covered. So just diving in, this is one of the biggest questions I get from founders. How much should I raise? And the first raise question is really hard. And one of the reasons it's really hard is because people ask the question thinking about just this one decision. And the first raise is not something that happens by itself. It actually should happen in the context of the entire life cycle of the company. So before thinking about how much the first raise should be, we should think about, well, how much should the second raise be? And the third raise, and if there's a fourth, how much is that? And what would the exit look like? And only after we have modeled all that out can we go back and figure out what that first raise is. And of course, in order to do that, we will have created a pro forma that shows our need for cash as we're growing. So when companies ask me, how much should we raise? I'm like, well, that depends. Let's look at the big picture, and suddenly it becomes a lot easier to determine how much that raise might be. So there's one concept I just want to share with you from the start, and we'll see how this works. And this is this concept of risk and how risk works. So here's our graph. By the way, here's time, and here is risk. So as a startup goes ahead, hopefully risk will be going down. Sometimes it actually goes up a little bit, but that's not good. But generally, risk will be going down over time. And as risk goes down, value is going up inversely proportionally, right? So this is an important aspect of how we think about this. So when we think about our capital strategies, at our first raise, do we want to do it here or here or here, where risk has gone down at this point? And the answer is typically going to be at a point when risk has gone down and value has gone up. And I'll talk more about that in a minute. But just in terms of, from the investor point of view, investors will always be saying, come back when you have more traction. One of the most frustrating things for founders to hear, more traction. Well, what does that mean? Well, it means de-risking, going down a risk stair. And so what are the things that cause risk to go down? Well, there are many, and it depends on the type of company, right? So for example, if you're a medical device, getting CE mark or FDA approval, big risk stair, right? Giant. So there's a huge gain in valuation and drop in risk. For tech companies, getting an MVP software developed, that's a big risk drop. And then even more so, getting your first 1 5 or 10 customers, sort of depending on the size of the software, but that sort of shows, oh, people will buy it. That's a risk step. Getting to €1 million a year in revenue run rate, that's a big risk step. So it's things like that. And I guess with with tech, most of the time it's just a matter of doing the work to develop software code, and then the risks are often market-based. But with, say, life sciences, we actually have to have science and nature cooperate with our hypotheses, and so sometimes getting something to work in nature in the lab is a huge risk. So for one of the things we'll do then is to identify what those key risk inflection points will be, and then we'll try to make our capital strategy work around those so that investors are more comfortable investing in de-risked companies, and that entrepreneurs are more comfortable because when risk goes down, their valuation goes up. I will remind you again, because I'm going to change to the next slide. If there are questions as we go along, interrupt me all the way throughout. Don't save questions for the end. Any questions? Okay. All right. I spoke a little bit the other day about uncertainty and attitudes about uncertainty, and all of this is we are projecting into the future. We're thinking about how these risks will be overcome. There's uncertainty, but we can certainly model this out. And so making these things clear, daylighting what those risk inflection points are, this is super important. One exercise I often use with startup founders is to ask them what they think the 3 big risks are for their company. And every company has at least 3 risks. And if a company doesn't know their 3 risks, then we'll send them back to work and have them try to figure out what those 3 risks are. And often they are thinking about something that is totally different than what I'm thinking about as an investor. And so we'll work towards alignment to understand what those key risks are. All right, so how much should that first raise be? It's not a random amount. There is a right number. And by the way, sometimes people will say a number like, I'm trying to raise $1 million, and they are struggling, investors are not interested, and then they come back to me and say, well, would it be easier if I raised $250,000, euros? The answer is no, it's harder. It is harder to raise $250,000 than $1 million if $1 million is what you really need. That sounds counterintuitive, right? You'd think it would be 4 times harder to raise $1 million instead of 250. But the reason that it is harder is when I think about the gap from one raise to another, what we're doing is we're kind of building a little bridge. And we're getting from one point of risk over to the other, and then we will invest more money here, and then we will build another bridge to that point, and so on. But if you only raise $250,000 and you need $1 million, you have a bridge like this. Now, if you're building a bridge for a highway, your cars are going to go like this. They will end up in the river. It's bad, right? So building a quarter of the way to the risk inflection point that you need to get to is very bad. And this is one reason companies are undercapitalized and they go out of business. So it's a huge risk to investors because we lost our investment, huge risk to founders because the company went out of business. So having enough money to get to where the next inflection point is important. And I just say that because investors, it's not a random amount of time. We always say it's 18 months. But that's about the amount of time it takes to overcome a significant risk gap. Yes, thank you for your question.
So, from what you said, you ask companies for 3 risk factors that they think are important.
Yep.
Does that imply that usually you expect them to have 3 rounds before they exit? In, let's say, some template. sort of like overcome the risks?
So I always struggle because I don't want to present anything in templates. Everything in venture capital is unique to the company. Some investments are one and done, boom. Some, I have a company I'm invested in that we are now on Series F. And that is not a part of the alphabet that angel investors typically get to. But so we're still involved in Series F, and we will probably go to G or H before we actually get an exit. So there's no real set of rules. But let me think about.
For those 5 years you mentioned,
Yeah.
18 months, 3 times 3, 5 years, ideal scenario, in that photo.
That's a not an ideal scenario. That's a typical, let's say, scenario. And it's a rule meant to be broken, but yes. But let's just say this, it's often the case that if you have 3 big risks, you've got 3 big risks today, and maybe it's all 3 of those you need to do here, and then these are going to be entirely different risks. So this risk might be, can you get to $1 million of revenue run rate? Can you get regulatory approval? Can you get your software done, working, tested, all of that? And this might be, can you scale? Which is an entirely different set of risks. Or can you develop the partnerships that you need? Or can you develop the follow-on products? Or, could you demonstrate low churn or turnover? So this might be an entirely different set of risks. So it's not like the risks you have today, you do 1, 1, 1. You have a lot of risks. And they change as you get bigger. But they somehow become a little more controllable. So it's good. But thank you for that question. That was good. All right. So this is one of these things. Your risks should be, or your raise should be as much as you possibly can. Why? So you can build a long runway. You won't run out of cash. Oh, thank you for that. And you will you won't be spending your entire life raising money. Companies who raise every 6 months are always raising. If you can go 18 to 24 months, that's going to be better. So remember this slide, as much as possible. Next slide should be as little as possible. It's the opposite, right? So the point being, each company has to figure out what's the biggest amount that is appropriate, but also not so much that you are diluting your company. If your company is worth $5 million today and you raise $4 million, well, maybe you actually can do that raise, but you have raised too much. You now have no equity left for growing. Your company will never become what it can be. So when I say as much as possible, I really don't mean that. I mean it in the constraint of against balancing it with as little as possible. So these are the things we think about. Well, how much do we need to have us accomplish this? And this is where project management comes in. And startups are notoriously poor project managers. But the better you can delineate all of the steps, the cost for each of those steps, and how this is going to be, and build in some risk factors, for things that don't go right, you can actually build a budget for getting from here to here, and that plus 10 or 15% for cost overruns that's how much your raise is, right? That's how I think about that. So it's just basic project management, breaking up into tasks, breaking into budgets, and how much people and external costs you have. So the other thing here, and I think I've said this a few times, less than 30%. So if somebody is raising more than 30%, it's too much. Your strategy is probably not working properly. And I don't know, is that's certainly the case in the US. Is that the case here? I'm just picking you guys, do you take more than 30% sometimes?
Not immediately, but eventually.
Oh, eventually, yes, absolutely, yeah. So any one round might be 15 to 25% is a normal amount of equity to do in a particular round. And one reason I don't want to take more than 30%, of course, is not to take all that equity and make it so there's not enough for future rounds, but also that's too much risk for me. I want to take smaller bites and say, all right, here I'm going to buy 15 or 20%. Now you go and do those things, take another step down your risk ladder, and then maybe we'll invest another round. So, and one thing you should know, and I don't know if this is also common here, but in the US, when many, not at angel stage, but Series B and beyond, when many VCs come together in a syndicate, they will have there's a term in their term sheet called pay to play. And what pay to play means is they all commit to invest in the next round or the next round and the next round. And so that you have to accomplish these milestones, but it means that these funds have all committed to each other that they will co-invest. And if they don't, maybe their preferred stock changes to common, various things might happen, but it gives a degree of security to the investors so that if only one wants to keep on going, they aren't left to shoulder the entire burden. Okay. Questions about that? As much as possible, as little as possible, find the perfect sweet spot, use project management, have a budget, add 10 or 15% for cost overrun. All right, so how do you do this? You should do what we talked about yesterday. You do a very detailed pro forma, figure out what your cash flow is, add it up, and then you'll see that J curve we talked about, the belly of negative cash flow, and then we'll break that up into steps. And there it is again. We saw this yesterday. We also saw this yesterday. I just put this in just to reiterate. Remember, it is burn only when it is totally in negative cash flow. So we are looking at negative cash flow versus spend. All right, so one question is, well, how much burn is the right amount? I have a portfolio company that got themselves into serious trouble. They had $6 million a year of revenue, and they had 123 employees, which is way too many, and they were burning $1.1 million per month. And so the answer is that was bad, way too much of a burn multiple. It was many, many times. And so they got themselves where they were burning so much cash, investors all pulled back and said, we don't know if we really want to be into this. It is too risky. And so they had to lay off a bunch of their employees. And then there was a down round, which is never good, where if you didn't invest, your stock went to 1/10 of what it was worth. So we invested, and we brought in a new CEO, fired the CEO, and the company reduced its costs, and now it's raised again, and now it's worth $250 million and is doing great. So just the problem was they weren't looking at this ratio, and their burn relative to their amount of revenue and their ability to raise the capital was way too high. So understanding that keeps you out of being at risk and out of causing down rounds. Yes?
How do you comment on the big fast which is going on these days, like Uber, Leap, and all those huge companies which are still burning cash for so many years and have huge valuations?
It's crazy. It's crazy. I read the Wall Street Journal every day, and some days I think, Wall Street Journal, you don't get venture capital because they say, oh, these companies are burning too much cash. But WeWork, Uber, they are burning too much cash, and they've gotten to a certain point where if they can't figure it out, I'm not sure they'll ever figure it out. They've grown, and it's still looking bad. And of course, they should be able to take their foot off the gas a little bit, spend less, and maybe not have the rapid growth that they have, but still continue to grow. So I think it's done a number of things that make venture capital difficult for everyone else. And one is it extends the time to exit. So what used to be, we used to say 10x in 5 years. Well, I have to tell you that my portfolio, the companies are not exiting in 5 years mostly. They are taking 7 plus years, and it's getting to be very challenging to run a 10-year venture fund because you have to make all of your investments in those first 2 years sometimes. And in fact, most Silicon Valley VCs are looking at 2-year investments. They're starting new funds every 2 years, which is a half to 40% of the traditional 4 or 5 year investment periods. So that's just one feed, there's all these trickle down effects of these mega rounds and what they're doing. It's also trickling down to affect valuations, I think, because we have one company in Colorado that was, I looked at in 2019. It was a Techstars, coming out of Techstars Accelerator. I thought, this is interesting. I had an introduction, the ability to invest, and it was a last mile delivery company. And I thought, there's lots of last mile delivery companies. This is hard to scale. I'm out. Guess what? Tiger Global came in, and now that company with less than $1 million of revenue is valued at over $1 billion. It's a unicorn already. I still wouldn't invest today. The guys are very nice. I like them, and I hope they are successful. But that kind of money, it's just crazy, and it creates billion-dollar companies who are not even expanding outside of the state of Colorado. That doesn't make any sense to me. And of course, you've all seen just in this last month or two that a lot of these funds are losing tons and tons of money and are in trouble. And so this strategy, while it seemed to be genius for a while, now with the time of global downturn, it's maybe not genius. This is a Warren Buffett saying that when the tide goes out, you can see who's swimming naked. Well, that's what's happening now. So, good question. All right. So let me ask a question. So when we are looking at dilution, I keep saying I want companies to keep as much equity as possible so that they can grow and they're still motivated and all of that. But we're talking about doing, maybe 3 or 4 rounds of investment. And I've told you that it's about 25% per round. So here's a question. If the first round is 25%, and then we do another round for 25%, and another round for 25%, and a 4th round for 25%, how much equity do the founders have at that point? 10, 15? Anything else? You guys know, so don't say. Well, you're supposed to say 0, because 4 times 25% is 100%. That's the intuitive, but it's a trick question, because of course, the founders don't have 25%. It's something like 36, 37%. How do we get that number? Well, I'll show you. And just a couple other prints. Dilution can be good or bad. Uneducated early angel investors are too afraid of dilution, and founders are too afraid of dilution. And part of the reason is they don't understand, that every round dilutes every previous round, and I'll show you what I mean by that. So when we think about it, we want to think about, well, yeah, my slice of the pie got smaller, but the pie just got a lot bigger. And so what we're all about is growing big pies, right? So that's important. The other thing is dilution ties into valuation. So when we do this next segment on valuation, one of the models that I call the cap table model will show you how investors and founders are diluted at each stage, and that it's okay, but it's something you need to model out and plan for. So don't be afraid of dilution, it's good. Oh, there it is, I had it on here. You already have the answer. So 0. So here's what it looks like. Here's what the cap table looks like as we go through to explain that a little better. So here's the first round. We have 2 founders who each have $500,000 or 500,000 shares. They have 50%, and then after that first round, they drop down to 37.5%. Why is that? 75%. It's really 25% dilution for that first round. They sold that. Their million shares, here's the important principle to understand. when they sold 25%, they still have 1 million shares. They didn't sell 250,000 shares. This is where people start to get confused. They sold 333,000 shares. How does that math work? Well, if you think about it, 1 million shares is 333,000s. So that's 3 of something. And if you add another 333,000 that you sell, that's 1/4 of the total shares outstanding. So by keeping the 1 million shares and selling 1/3 again, they own 3/4 of the shares, and now the new shareholders who own this 333,000, they own 1/4 of the shares of the company. It's a little bit to wrap your head around. Is that clear, or should I say it in other words? Or good? Okay, so big principle. Where do these shares come from? They come from what's called treasury stock. So we've authorized and issued, when we start the company, these 1 million shares to the founders. So they own 100% of the company. And then we might have 9 million other shares sitting there in treasury that are authorized but unissued shares. And these shares will be used for our stock option pool. They'll be used for future raises and for this raise where we're selling 333,000 of them. Otherwise, they just sit there. Nobody owns them. They're just ready to be issued. Yeah?
Are these shares automatically introduced to the investors at the start?
Oops, I have a motorcycle out there. I can't hear you. I'm sorry.
You're saying that you've planned 900,000 more shares.
9 million more
9
shares.
million, pardon.
Yeah.
Do you represent this kind of thing in the proforma? In the first round when you were talking to the investors?
In the pro forma?
Yes.
No.
Proforma in the plan.
In your capitalization table. Yeah, you would show that in your capitalization table.
So they will be aware that they will be expanding
Yes.
and the logic of this
Yeah.
will be explained.
So yes, it's not in your pro forma, not in your financial statements. It's in your capitalization table. And by the way, this is what a capitalization table looks like. It's list of who owns stock, how many shares they have, how much they paid, and so on. So that is one of the key due diligence things that every investor will ask you for. Let me just tell you one other thing about 1 million shares, and then there's 9 million others. Sometimes that's how it happens, but when we get to term sheets tomorrow, one of the terms that we might have is called control provisions. And the one control provision might say, you can't issue any more stock. You can't sell this stock unless half or 2/3 of the preferred shareholders give you the go-ahead to do so. And there's a couple of different ways to do it. And one is you don't issue the 9 million shares as treasury. You might only issue these 333. Then you have a resolution of the board and the preferred shareholders. Then you will issue another 444. And that makes it so that you can't do sort of the Mark Zuckerberg thing he did in the movie with Facebook. So when I say 9 million might be out there, it's theoretical 9 million in some cases. Okay, so 75% after the first round, that's pretty intuitive. What about the next round? Well, it turns out that 1.333 million plus another 1/3 of that is 444,000 shares. So this investor number 2 now owns 25% of the stock of the company. So he owns 25, but this guy, the 25%, now got diluted down to 18.75, and their 75% went down to 56-ish percent. So each round, we're not just diluting the founders, we're also diluting the investors of the previous round. So that's why you end up as founders still having shares. So at the end, we've sold 1.777 million shares, 2 rounds. Does that make sense? This is totally not obvious to most people if you haven't learned it. So really important principle when you're thinking about capitalization tables and stock. But also not to be so afraid of dilution. So I was just asked earlier today, what's a normal amount at the end of the day for a company to have, for the founders to have as their percentage? So here we've got 56%. Is that a good amount, a bad amount? And the answer is, it depends. If you're starting Google, that'd be great. But probably you're gonna end up with 5 or 10%. On an average, it might be 30 or 40%. Yeah?
Just to be clear for the audience, so the founders are not selling ownership, but they're getting capital contribution, and because of that, their ownership is diluted in the company. So
Yeah.
they're getting more money into the company.
Good way of putting it. Yep. And if you think about it, it's good for them because this dilution, now their company, if these guys just invested, well, I guess here it says $500,000. Well, they have their pro rata share. They own 75% of that $500,000. So they don't get it personally. This is an important thing. I remember with my first company, I was 26 years old, and I was like, well, wait, it's my company. Don't I get the money we raise? And the answer is no, you don't. It goes to the company, and your wealth in general goes up, but you don't keep the cash. Investors don't want you to have the cash. They want the company to have it. Okay, so here's an example of a real world company that went through multiple rounds, and I just want to show how sad it is for these poor angel investors who invested early on and got diluted way down. And so the story begins here, January 1996. We had some angels. They put together $2 million to invest in this company, which had a pre-money valuation of $4.6 million, which back in 1996 was actually a pretty high valuation. So 4.6 plus the 2 million that was invested, we ended up with 6.6 million post-money valuation. So for that, they got 30.3% of the company, quite a bit. So January 96, so September 96, so not that long, 9 months later, these guys didn't follow the 18-month rule. The company has gone from 6.6 million post-money up to 7.17 million pre, so almost 2.8x or something growth. They raised 8 million with the post-money of 25%. And look how sad. Our angel investors who had 30% are now down to 19%. And this makes sense because you think about it, 8 million is about a third of 25, and so they've gone down by about a third. So this is how the dilution is working. So now we have a $25 million company, and May, so this is another 6 months later, the company is now worth 69 million, so 2.6x growth-ish. They raised 10 million, so 1/7, and they end up at $79 million. And sadly, these guys get diluted down further. One more round happens. We go from 79 million to 135 in 5 months, 4 months. This is going fast, but this is, pre.com, right? So they raised 21 million, post-money 156, another dilution down to 13. At the end of the day, when they get to their exit, the angels only own 10.8%. So sad, 1/3 of the equity that they bought. Why would anybody be an angel investor? So they're 2 million, 10% of 1.8 billion. Oh, it's $180 million. That's a 90-something X return. That's pretty good. I'll do that any day. And that only took 3 years. So the IRR on that is incredible. So anyway, point being, if the pie is big, getting diluted is not a bad thing. Questions on that? Good. I'm sure the founders did well too, by the way. Okay, so there are some people who say valuation doesn't matter. And I'm serious, this is like a Silicon Valley thing, and people will say valuation doesn't matter, you just need to get into the deals because if it's going to be a unicorn, that's going to be great, and if it's not, then who cares anyway? Well, I do. I care a lot about valuation for two reasons. One, if it's going to be a unicorn, and we're negotiating between $5 million and $10 million pre-money valuation, well, if it's $1 billion at exit, then maybe that difference means hundreds of millions of dollars to me. So if it's going to be big, I really care about valuation. And if it's going to be little, then I also care because I want to get money back to give to my limited partners in my fund. So it always matters, no matter if it's a big, little, or intermediate thing. So when I say valuation is critical at all stages, what we're going to do in this exercise is we're not just going to project, well, what are the milestones we have to hit in terms of risk inflection, and we're not just going to say how much do we need to raise at that next raise, but we're also going to say, well, what would the valuation be at that point? So if you think it's hard to do your valuation now, when you're a pre-revenue company, we're going to make you do valuation 18 months from now, valuation 18 months after that, and then of course your exit valuation. So that I'll show you how that works. And the main reason we do that is because it all needs to work together. So when I'm doing valuations on first round valuations on pre-revenue companies, I'm modeling all of those raises out because I want to model how much dilution founders and I will have. And I want to make sure that founders remain motivated and that I am going to get my target return. And I want to make sure that the follow-on VCs who come after me get their target return. Balancing so that all parties, founders, early stage investors, later stage investors, get their target return is really hard. But this is why we go through these exercises. All right, so I mentioned this. Figure out what the milestones are. This is something any team should sit down, figure out milestones today, milestones 18 months from now, milestones 36 months from now. And how do you find that out? You should do it, and then you should go talk to Series A investors and say, hey, I'm not raising money now. We just raised our seed round for $500,000 or whatever it is, but we're growing and we think we have a good match for your fund thesis. What do you think would be good milestones for us to achieve in order for you to feel we have sufficient traction? And most funds will tell you, and they won't, by the way, don't say, okay, so if we do those things, will you fund us? The answer is no, because it might take you 10 years to do it and they won't be interested. But do talk to them and find out what they look for, and then that will help you to develop your capital plan. And it also begins creating that relationship with later stage VCs. This is a relationship game. The more that you can create those relationships early on, the better. Okay. So this slide has gotten me into trouble a little bit. I've put this comment up here: if you're cash flow positive, you're not doing it right. And it's kind of an extreme statement. If you're cash flow positive, you could be doing it right, maybe. But I put this extreme way of saying it up because I just want to make sure people understand this venturenomics concept we've been talking about all week, and that it's not cash flow that we're working for. If you have cash flow, awesome. If you don't, that's okay too. And I talked yesterday about the example, if we have $1 million at the bottom of the line, and we didn't need to, we could grow 5 million in sales and then 25 million of enterprise value. Well, that's what I'm talking about here. Just balancing our cash needs with revenue growth and enterprise value growth is important. Let's see. So the other thing here is cash flow positive companies tend to grow more slowly. Not always, but mature companies grow 10, 20% per year, and hyper growth companies are doubling, tripling every year. So we'll be balancing. If you need to be a fast growth company, if you're in a highly competitive marketplace and you need to get market share, going slowly and being responsible and having positive cash flow could be stupid. If you're sort of in cash cow type of industry and you're not in something that is highly competitive, then sure, go ahead, don't be diluted, work off of cash flow. Cash flow positive options good in those cases, and then I would just say build a strategy so that if hard times come, you can take your foot off the gas, reduce your spend, and continue to survive between rounds. I've talked about this a little bit, just building in that cash buffer. You've budgeted 10 times, but another 10 or 15% at least. It always takes longer and costs more than you thought. What's that?
Cash flow negative is good if you're growing 100 or 200% per year. If you're growing 10% per year and you have negative cash flow, that's bad.
That's a really good way of saying it. So right. If you're doubling, tripling, cash flow negative, awesome. 10% cash flow negative, that's not going to last very long. Like that. All right. So I always tell people, after you close your round of funding, it's been exhausting. You're putting yourself out there. You've got millions of no's. You're beaten up, and I'm telling you, you should go out and start your next raise immediately. Well, it's true. This is a relationship-based game, and you should do it. But you know, when I say this, I don't know how well you guys can see what I'm doing up here, but here's sort of your effort graph. Is you're raising, and you close. The next day, you should be doing that same thing. So this might be, one meeting a month, two meetings a month. It's not, frantic like you are here, where you're meeting with 3, 4, 5 people a day. So when I say you should always be raising, having a meeting a month, just sort of keeping relationships going. One thing I always recommend is, as you're meeting with potential investors, put them on your email list, and once a quarter, send them an update. Here's what we're doing great at, here's what we need help with. Show them that you're going to be a good communicator once you get investment from them, but also show that you're transparent and how you're overcoming challenges. And then when you come to them 6 or 9 months later, they have developed a much higher degree of trust in you by having shared that. Investors, believe it or not, I won't say we like to see bad news, but we hate seeing good news, we're out of business. So we would rather see bad news, we can help, and we can toss in and sometimes fix things, make introductions, do all the things that we do other than capital, and then we're more likely to make those follow-on investments. But somebody who is painting all of these great quarterly reports and then they're suddenly out of business, they're dead to us. So be a partner. Okay. Just one thing to think about. I have seen founders who they miss the point that raising venture capital is not success. Raising venture capital is not success. It may be an important part of growing a company, but the goal is to grow the company and to grow revenues and to grow value and then to sell it with an exit. Some people are thinking, oh, well, I just raised 10 million. I just raised 20 million. This is so successful. It's not. That's just a step along the way. So just in terms of setting mindset, raising capital is important, but not the milestone you want. All right. Let's see. We have talked about these things. One thing about when you're doing Series B and beyond, I think about, people ask me, well, how much, is a typical Series B investment? I'm like, I can tell you a typical pre-seed might be $500,000 to $1 million, even though I've seen $6 and $7 million, but that's the norm. I can tell you a typical seed might be $1 million to $3 million, at least, in Colorado. And then Series A might be 5 to 7 million, something like that, 5 to 10. But then Series B can be anything. It could be 5 million, could be 100 million. And it's sort of like a horse race where all the horses start out together at the beginning, and then as you get farther down the alphabet, they spread out. And so hard for me to project what a raise is going to be without knowing a lot about the specifics of the company, the industry, the competition, all of that. Just the message to founders is, sometimes if you are thinking about this, You have only one company. You have to be focused on just the one thing. Whereas investors, we're diversified into many. And so if you are thinking, oh, well, I'll just keep raising money, and you've spent 10 years of your life on this one company, maybe by the time all of that dilution occurs, you end up making the same amount of money as if you had exited in year 5 or 6. And then you could have taken that money, started your next company, been super successful, and gone on. So think about serial entrepreneurship and not getting in love with any one company and getting stuck there. All right, Monday we talked about exit modeling. And so I'll just say, I'll just remind you if you weren't here that we do all the work to create a believable pro forma, and we look at what our potential exit year is, and then we do a lot of work looking at comparable transactions for an industry and geography. We figure out what the norm is for those multiples, and then from those two pieces of work we will come up with a likely exit number. And that's going to be part of what we do for this capital strategy as well. Okay, can't stress this enough, they all work together. All right, I'm gonna show you what this looks like in 1 second, but just, this is finance, it's numbers, it's risk, it's all of those things, but I can't stress enough, it's about relationships. All right, so this is ugly because I am not a graphic designer, but this is just something I did in PowerPoint, and it's super simple when you look at it, but there's a lot of work that goes into it. So the capital strategy canvas is something that a team can do together after they've done their pro forma and exit strategy work. And basically the idea is to do these very simple things. Start here and figure out what your milestones are. What are these key risk inflection points, and what do they look like for your company? So those are going to be something like, first round might be launch your minimum viable product, achieve 250,000 in revenue run rate. Cool, that's good traction. When a company comes to me with that, I'm like, oh, let's talk. Then, and so for that, you might need $500,000 and 12 months to accomplish that. Then you'll raise $3 million for a Series A, and by the way, it's not even it's a hypothetical company, so don't get upset about strategy here, but say you have your Series A and you raise $3 million, you're selling 25% of the company. Angel rounds are sometimes a little bit less, so 20% I put there. And so now we're raising $3 million, $9 million pre, and here we're going from $250 to $2 million run rate. So that's eight-ish times growth. That's pretty good. And then the final one here, Series B, another 18 months. We might raise 10 million for another 25%, 30 million pre, 40 million post-money valuation. And for there, we're getting to 8 million and beyond. Once again, don't get too upset about these numbers one way or the other, but I guess if you've raised 13 million, you might hope to be more than an $8 million run rate, but it depends on your company. So this is the idea, is we're looking at just what the raise is, how long it takes, how much are we raising, what's the valuation so we can see what the dilution is going to be, and what do we need to have accomplished. Super simple, right? There's nothing surprising in here, and yet this is an exercise that probably fewer than 1% of startups go through. And I think it's super valuable just to be thinking all the way through, and it makes your capital strategy for the first round make a lot of sense in context. So that's the capital strategy canvas. Are there any questions about that? I have never spoken so clearly to any group as you, because it's all crystal clear. All right, well, that is the end of this segment. So we will move into valuation then after this, but we'll take a little break. It is now 3 o'clock, so come back at 3:10, say?
Just
yeah.
Quick comment on defining the size of Series A, Series B, and whatever, in context of the size of the market and the geography. So typically this is what we see in well-developed financial markets like the United States. In financial markets which are underdeveloped, which is the case with Macedonia, factors that are influencing the size of the rounds, whether it's seed, pre-seed, Series A, Series B, is the size of the market, the size of the potential market, the availability of capital, which is available for risk investments, and also the risk of the market. So all those things are scaling back the sizes of the rounds. So if we are talking about seed, typical seed in the United States, which is starting with $250 million.
That's very low, yeah.
Yeah. But here in our country, that's far below.
Yeah.
So even in this region, if you're talking about the region Western Balkans, if you're talking about the Balkans region, Series E is something between $500,000 and $2 or $3 million.
Mm-hmm.
So we need to have that in mind. So do not expect to get from potential investors in this region valuations which are either the sizes of rounds which are comparable to the US or somewhere else.
Yeah. So that is a really important insight, and I'll share with you a story. Just even within the United States, we had research done at a conference we did a few years ago where Silicon Valley Bank looked at all of the deals in Silicon Valley and then all of the deals in Colorado. So if you don't know, we're in the middle of the country. There's cornfields and wheat and some mountains. We ski, it's all good, but we are not in Silicon Valley. And our land costs in Colorado are less, our business costs are less, our labor costs are less. And so it costs us about 1/3 less than a company doing the same thing in Silicon Valley. And so to your point, the valuations on average in Colorado, even within the US and single apparent monolithic market, are actually quite different. So companies in Colorado are valued about 1/3 less of the price than what we would see in Silicon Valley or in Boston, New York markets. So those points about availability of capital, but just even very rationally, just what will it cost you to get from one place to the other? In Colorado, it will cost you 1/3 less. In North Macedonia, it may cost you significantly less. And so that's why I think this idea of breaking up how much it costs to get from one place to the other is important. And then, the other thing that is interesting here, and I mentioned this the other day, is that, most of these raises are going to be in this 15 to 25% range. And so you also want to make sure that you're not selling too much or too little of the equity in your company. So, yes, you had a question?
Why would I raise a Series A in Macedonia or in Colorado when I can get much higher valuation in the States or Europe or something like that?
It's six.
What's the motive for the startups to look for VCC in the region or Colorado compared to
It's 6 of one, half dozen the other in some ways, if you look at it, because you'll get more money in those other markets, and it will cost you more money to accomplish the same tasks. So
talking about raising, let's say, from VC to the States, raising money in the company running this money. Why would you do that compared to?
Well, if you're able to go to a VC in the States, it depends on the industry, it depends on the product, on the service that you would like to offer. So it's not so easy to go to a VC in the States and to pitch your product or service.
But it's easy to go to Central East European business, like there are a bunch of them.
Not always. Not always.
yeah.
I mean, in some cases, yes, but not always.
If you can do it, absolutely. And this is kind of, and by the way, I've said this other days, but I'm here to learn from you, and I'm learning a lot about this ecosystem, so I don't pretend to really understand all of the nuance. But what I am seeing, I'm thinking if I were a founder in North Macedonia and I could raise that money elsewhere, and then I would stay here in North Macedonia because I have smart people who work hard and will work for significantly less, and that gives me a competitive advantage over somebody who's in Central Europe or the US. So I think the more I look at just the companies I've been meeting while I've been here, there's a lot of opportunity to play that labor arbitrage and in some cases maybe even that capital arbitrage that you're talking about. Sometimes, of course, a smart VC from Central Europe or from the US will say, well, why are you asking for so much money? You don't need that much. So you need to have a good answer for that. But certainly that is part of the analysis that any VC anywhere will use in their both assessing your capital need and your valuation.
And it goes again it's associated with the risk that that as an investor you would have with investing in a company in Macedonia, given all the business environment, the judicial system, the rule of law, the enforcement of the law here, and also the addressable market, how far you can reach from Macedonia, ability to sell to the addressable market. Eventually, you can be perfect technology developer, or but if you don't have sales skills, if you can't sell your product or service, that's a problem. And those are the things that eventually every investor, no matter where, would address it.
And that you have to pay the sales people who
Yeah.
sell.
You cannot with local investment.
Yeah, well, and obviously I think any of us would think we start here, use this as a place to start a business, and then expand to Balkans, expand to Europe, expand to US, as is appropriate when it's appropriate. But this is a good place, I think, to start, but the cost of selling to people farther away, of course, is more expensive. So that's something to think about. All right, but good question. It's important. And, that each company, it also depends on, what your market is. Maybe you move the whole thing, but still have some labor and operations here to take advantage. Take advantage in a good way. No. All right, so now it's 8 after, so maybe we'll come back at 20 after the hour. Take this off by saying what I'm going to cover here is part of it will be what you're hoping I will talk about, which will be how do you value a pre-revenue company. But another part will be talking about things that have nothing to do with your company that will impact value. Things like being in Macedonia, things like global downturns, wars in Ukraine, supply chain, all of those things will impact your valuation. So I'll talk about how you can use some of these things in negotiation as well as just coming up with the number, which, by the way, we won't come up with the number. We'll come up with something though. All right. So there is a lot of mythology, at least in the US, about how you can't value pre-revenue companies. And so we are here to show you how it happens every single day. And if you look at Crunchbase or CB Insights or PitchBook, you'll see thousands and thousands of deals are being done pre-revenue with valuations attached to them. So I don't know what these people think are happening who say it can't be done. So we'll talk about multiple valuation models. And here's one principle is it is certainly a highly, there's some subjectivity involved. It is not a perfect job. There's as much art as science in coming up with valuation. But one way that we seek to overcome this is to use 5 different methodologies, all of which, if you think about this is the nut of valuation we have to crack. Some will be through DCF, discounted future cash flows. Some will be through risk adjusted, the scorecard, looking at comps, and various other methods. And so we're going to look at a lot of different things. So we'll start with uncertainty that's this much. We know your valuation is worth somewhere between $500,000 and $10 million. We'll use one. It might be between 1.5 and 2 or 9. And it gets narrower and narrower. And our goal is not to come and get you a valuation that is like $4,367,000.43, which would be ridiculous, but to show you what a reasonable negotiation zone would be, where if the ultimate deal ended up being anywhere between, and these are just random numbers, by the way, not anything, but between 4 and 5 million. Then if it was 5 million, it would be fair for founders. If it was 4 million, it would be fair for investors. Somewhere in that zone is what we're looking for. Okay, so there are tons and tons of what I would call real company valuation methods and tools that are used once we get to Series B and C, or public market things. We will touch on some of those things, but for the most part, this is none of the models we will use revenues or EBITDA as a tool. With that being said, a few years ago I asked myself, well, when would you start using net revenues as part of the valuation model? Because certainly it does get to be relevant at a certain point. And one reason we don't use revenues is if somebody's at $100,000, we're not going to say, all right, well, 5 times revenues is $500,000. That would be, in many markets, too low of a valuation for a company who is at that stage. So we will look at different ways of doing this that will not use revenues at all. I think maybe somewhere, I'm just making this up, but around $2 million a year of revenue, somewhere around there, it can start to be a factor that can be used. I'll sometimes use it to test what we've come up with, and I'll talk more about that in a bit. So here's one reason I think a lot of people, especially founders, struggle with valuation, is it seems like this where do these numbers come up from? What drives it? And how do I do this? But I just want to say that valuation of startup companies is just like valuation of bread in the grocery store. And how many people here have bought a loaf of bread ever? I'm just seeing how many people are listening, because you all have probably bought a loaf of bread at some time or another. And so you can see here, these are $3.50, $3.99, probably cheaper here, but this is, typical prices of bread in the US. You go and, you look at the shelf and you go, yeah, that's about the price. That makes sense. And some are a little more expensive, some are on sale, all of those things, but there's all this zone. And if you saw a $20 loaf of bread, you'd think that's crazy. And if you saw a 50-cent loaf of bread, you go, well, what's wrong with that? That's way too low. So there's this zone, which in this case is $3.50 to $3.99, and that's the zone of valuation of a loaf of bread. That's general economics, something that we all do every single day. We buy cans of Coke, water, bread, and we all kind of have seen this over and over and over again, and we have a feeling for it just by having seen it over all this time. Well, once you've looked at a few hundred venture deals, you start to look at venture deals the same way you look at bread or Coke or a liter of gas or whatever it might be. You've seen a lot of them, and you can kind of say, oh, well, this looks like a $3 million deal or a $5 million deal or whatever it is. And there are things that will drive you to make that decision. So these 5 techniques I will show you is just sort of pulling apart some of the things that investors are thinking about when they value a company. But once you've done it enough times, then you have the experience you don't have to fill out the damn spreadsheet every single time. But we put the spreadsheets together to sort of make it clear how somebody might make these decisions. So just like bread, super easy, right? Okay. All right, so I did what anybody should do. I looked up, definitions of valuation on Google, and I put this first one is actually my favorite: the present value of future cash flows. And if you've been listening to me all week, you know that I am focused on the exit strategy. And so, what is the future cash flow for any startup investment? It's the exit. So when I think about valuations, well, the value of an investment I make today is going to be based on the value of the potential exit of this company. How long it's going to take, how big it's going to be, and what the likelihood of the company actually accomplishing that exit strategy is. That kind of makes sense, right? Just like anything else. When a lot of people look at this present value future cash flows, like when I was getting my MBA, I remember we had to do all these things with the math and figuring out loan amortizations and what the IRR was and what the value of those cash flows was. Well, this is very different because the cash flow here is something like put in $1 million, and then year 1, cash flow is 0. Year 2, cash flow is 0. Year 3, cash flow is 0. Year 4, cash flow is 0. Year 5, hopefully, cash flow is $10 million. So that's sort of the venturenomics of future cash flows. And I'll just reiterate this, I think I said it the other day, but investors, angel investors and VC investors, don't get the cash flow that your company throws off. So if on your financials you're showing, $100,000 or $1 million on the bottom line, that's not the cash flow I'm talking about. And that cash flow is roughly irrelevant to me because I don't get it. That stays with you and the company. So the cash flow I'm talking about here is the cash flow that comes from an acquirer or an IPO and then is repaid to investors. So just to make that clear. So other ones here, mutually accepted valuation between company and its financial backer or backers. This is great, but it really means if you get a bunch of people, they all have to agree at the same time on the same terms, and that's how syndicates work. And whatever they pay is probably about what it would be. However, I've seen so many times where you get 2 or 3 inexperienced investors who either have a valuation that's way too low or too high because they don't really know what they're doing. So this assumes some sort of sophistication on behalf of those backers. And then, of course, other things, the founders have to, of course, agree on that valuation. All right. So here's something, now that we've got the definition of value out of the way, well, what about price? There's a difference between what you might come up with for the value of a company and then what you as a founder decide to price it at, what you might tell investors that you expect to get as your starting volley in your negotiation, and they are different. And so just like some of those loaves of bread were on sale and the price was 50 cents or $1 less than the value, it was less than the other ones. Or car lots, about this time of year, if you've got a bunch of 2021 cars or even 2022 cars on your car lot, if you're an auto dealer, you want to get rid of those to get the 2023 models on the lot. So what do? Your BMW is worth the same today as it was yesterday, but you might take 5,000 euros off the price. And you're reducing the price to move it faster, even though the value is the same today as it was yesterday. So with regard to thinking about price and value for startups, sometimes the difference is time. Do you need to raise this money quickly? Well, you better not try to maximize value. Do you have a lot of time and you don't really care, you're sitting on a pile of cash? All right, you can, try to maximize value a little more. So a few years ago, I had a company we were investing in, and I did all of these methodologies I'm about to show you, and I came up with a valuation of $4.25 million for the company. So I talked to the CFO, and he said, we're pricing this at $3 million. And this is a weird negotiation, right? Because he's just offered me 1.25 less than I was willing to pay. And I said, I get 4.25. And he said, yeah, that's what I get too. And he had been an investor himself, so he was using the same sort of techniques I used. He said, I get 4.25 also, but here's the deal. I need to get this software done, people hired, and in 4 months, I have 2 pilots that need to launch. I'm raising a relatively small amount of money to get this one project done, overcome this risk thing, make an impression on my 2 big future clients, and I'm willing to take that dilution to get this thing done fast. And sure enough, it took just a couple of weeks, and usually it's a couple of months. So people piled on. It was a telehealth company, which ended up doing very, very nicely, and those pilots were huge successes. One was with Kaiser Permanente, which is a huge healthcare system in the US and has continued to be really big. So that was a really good strategy to price it, more than 25% off in order to get that cash. It would have taken him probably 3 months to raise the money if he'd done it at the full 4 1/4, and then that would have been too late. So just thinking about price and value versus is a part of your strategy. So I'm assuming that the main reason we're talking about value is founders want to raise money, they're going to sell equity, investors want to buy equity, we need to agree on how many shares we're going to get for how many dollars or euros or whatever it is. But there's lots of other uses that we have for valuation, and certainly percentage of equity, thinking about buyouts. But here's another one that we need to be thinking about quite a bit is thinking about employee compensation and stock options or warrants that we are giving to them. And the reason this is important is, well, if we're giving shares, we should know how much that is. And one thing I'll just say that I see a lot of startup founders doing is they'll say, oh, well, I'm going to give 0.5% to this person, or 10% for a new CFO or whatever, and using percents of the company as stock grant strategies is, I think, a big mistake. And you can go look on Google for how much should I pay a CFO, or how much should I give a board member, or whatever, and you'll actually find some numbers. But I don't know what the people who wrote those numbers were thinking, because they don't say, well, here's what it should be if the company is a pre-revenue startup, or here's what it should be when the company's at 5 million in revenues or 20 million or whatever. I mean, if I could be a board member for a multinational company for a 0.5% per, to do that, I'd take that any second, right? That'd be billions of dollars. So obviously, my goal when I'm advising companies for using stock for payments of various types is to say, all right, well, one share is worth, whatever it is, $1. And then if I'm thinking, all right, I want to give somebody this amount that's worth $100,000, then I'll give them 100,000 shares. The other reason that this is important, there's several reasons, but the other reason is sometimes people will say, well, we're going to give you 100,000 shares per year as your compensation plan. But that's a big mistake. If you don't think it through, well, 100,000 shares might be worth $100,000 today. Next year, hopefully your valuation has roughly doubled and it's $200,000. And then the next year, it might be $400,000, and the next year it might be $800,000, and you probably don't intend to give that amount of compensation to that person who's doing the same job for all of those years. So just sort of promising a fixed number of shares per year doesn't make sense. In fact, almost nobody does that. I've seen people think about it and they stopped when they figured out what was going on. Usually, you'll figure out the total compensation package, and almost always there'll be a 4-year vesting period, right? So you'll get 0, 0, 0, 0 up to your first 12 months. Some people will give, 1/48th for the first 12 months. I usually give 0 up to 12 months, and then maybe quarterly until you get to 100% at the end of 4 years. So vesting is an important way to do that. I'll just say one other thing. A lot of founders push back on the idea of vesting, and we'll talk a little bit more about this tomorrow when we go through term sheets. But I'll just say founders, if you have, say, 3 founders, vesting your shares makes a ton of sense, and making it so that you as founders have a 4-year vesting. And the reason is it's not uncommon if you have three people who are joining that somebody doesn't like not getting paid very much, having to work too much, not liking the uncertainty, and they see a better opportunity somewhere and they leave, and they take with them 33% of the shares of the company. And some people mistakenly think that being there at the beginning creates value. Well, it doesn't. It's sticking there all the way through, 4, 5,